Good evening. I will be discussing the Z double prime score and the bond rating equivalent in continuation of the last topic, which is the Altman Z score model. Z double prime score is the revised model of the Altman Z score model, which is for the non-manufacturing companies and the emerging market. Compared to the Altman Z model, here in the Z double prime score, the sale over total asset was completely removed from this model. The Z-score model is based on four key financial ratios. The following are the key financial ratios that make up the Z double prime score model. X1 is equal to the working capital over the total asset. To, uh, to, to solve for the working capital, you need to subtract the total current asset to the total current liabilities of a company. The value of a company's working capital determines its short-term financial health. X2 is equal to the retained earnings over total asset. The retained earnings over total asset shows the amount of retained earnings or losses in a company. X3 is equal to the EBIT over total asset, which is EBIT measures the company's profitability, and it also refers to the ability of a company to generate profit solely from its operation. Lastly is the X4 is equal to the book value of equity over total liabilities. To solve for the book value of equity, you need to subtract the total asset to the total liabilities. Book value of equity is also known as the shareholders' equity. It is a firm's common equity that represents the amount available for distribution to the shareholder. Z dollar prime score formula for non-manufacturing company is as follows. And here is the financial ratio that you will need to solve later. Investor use this Z dollar prime score to make decision on whether to buy or sell a company's stocks, and depending on the assessed financial strength. To interpret the Z double prime score, the results are distributed into three risk ranges. Value of Z over 2.6 represents that the company is in safe zone, and such company is less likely to head towards bankruptcy and considered to have a good financial health. And here, investor may consider purchasing a company's stocks since there is a minimal risk of business going bankrupt in the next 2 years. And a value of Z between 2.6 and 1.1 represents that the company is in caution zone. The companies is considered to be a moderate risk of bankruptcy. And a value of C of less than 1.1 represents that the company is in distress zone. This company shows a large risk of heading towards bankruptcy and considered to have a poor financial health. Here, the investor may also consider selling the company's stock to avoid losing their investment since the score implies a high probability of going bankrupt. This score uses statistical techniques to predict a company's probability of failure using the following 7 variables from a company's financial statement, which contains the current asset, the current liabilities, the total liabilities, the total asset, EBIT, retained earnings, and the book value of equity. An example of a non-manufacturing company is the Manila Electric Company. To solve for the Z double prime score of this company, you need first to get the value of the 7 variables for the year 2019. After that, you will now substitute it to the financial ratio. So to get the value of X1, you need to divide the working capital to the total asset. So to solve for the working capital, need to subtract the total current asset, which is 117.7 thousand, minus the total current liability, which is the 127.6 thousand, divided by the total asset, which is 357,000. So the value of x1 is negative 0.03. To get the value of x2, you need to divide the retained earnings, which is 67.1 thousand, divided by the total asset, which is 357,000. So the value of x2 is 0.19. To solve for x3, you need to divide the EBIT, which is 31.9 thousand, divided by the total asset, which is 357,000. So the value of x3 is 0.09. To get the value of X4, you need to divide the book value of equity to the total liabilities. To solve for the book value of equity, you need to subtract the total asset, which is 357,000, to the total liabilities, which is 271.8 thousand, divided by the total liabilities, which is 271.8 thousand. So the value of X4 is equal to 0.31. After we get the value of the financial ratios, we are now going to substitute it to the formula. So 6.56 times negative 0.03 plus 3.26 times 0.19 plus 6.72 times 0.09 plus 1.05 times 0.31 is equal to 1.35, which is in gray zone. Manila Electric Company has a Z-score of 1.35, means that the company is in caution zone and with a moderate chance of filing for bankruptcy. Altman Z-score model is also used in emerging market. In the emerging market model, a constant of 3.25 is added. This is done to standardize the score with a score of 0 equated to a D-rated bond or the default. The formula of Z double prime score for emerging market is as follow. And here is also the financial ratio that we will be using to solve for it. So, to interpret the Z double prime score, the results are distributed into three risk ranges, which is the same as in non-manufacturing company. An example of emerging market company is the Manila Electric Company. To solve for the Z double prime score of this company, you need first to get the value of the 7 variables for the year 2019, and after that, you will now substitute it to the financial ratio. To get the value of X1, you need to divide the working capital to the total asset. So to solve for the working capital, you need to subtract the total current asset, which is 117.8 thousand, minus the total current liability, which is 127.6 thousand, divided by the total asset, which is 357,000. So the value of X1 is negative 0.03. To get the value of X2, you need to divide the retained earnings, which is 67.1 thousand, divided by the total asset, which is 357,000. So the value of X2 is 0.19. So to get the value of X3, you need to divide the EBIT, which is 31.9 thousand, divided by the total asset, which is 357,000. So the value of X3 is 0.09. To get the value of X4, you need to divide the book value of equity to the total liabilities. To solve for the book value of equity, you need to subtract the total asset, which is 357,000, to the total liabilities, which is 271.8 thousand, divided by the total liability, which is 271.8 thousand. So the value of X4 is 0.31. Now that we are already know the value of this financial ratio, we are now going to substitute it to the formula. So 3.25 plus 6.56 times negative 0.03 plus 3.26 times 0.19 plus 6.72 times 0.09 plus 1.05 times 0.31 is equal to 4.6, which is in safe zone. So Manila Electric Company has a Z-score of 4.6, means that the company is in safe zone and with a low chance of filing of bankruptcy. Here, the investor may also consider purchasing the company's stock since there is a minimal risk of the business going bankrupt in the next 2 years. Bond rating equivalent, or the BRE, is used as benchmark of credit worthiness. A bond rating is a grade given to a bond by a rating service that indicates its credit quality. The rating are published by credit rating agency. They provide evaluation of a bond issuer's financial strength and capacity to repay the bond's principal and interest according to the contract. There are three main rating agencies that evaluates the creditworthiness of the bonds, which is the Moody's rating, Standard & Poor ratings, and the Fitch rating. Standard & Poor Global Bond Rating is the oldest bond rating agency and one of the three nationally recognized statistical rating organizations accredited by the U.S. Security and Exchange Commission. The company covers more than 1 million credit ratings on government and corporate bonds, structured finance entities, and securities. The main goal of the Standard & Poor credit rating or bond rating is to assess the security's default probability. Next is the Moody's Investor Service Bond Rating. It is another bond rating agency that is accredited by the NRSRO. Unlike in the Standard & Poor rating and the Fitch rating, the primary purpose of the Moody's rating is to evaluate the projected losses in case of a default. Next is the Fitch Ratings is the smallest bond rating agency among the big three agencies. Fitch market share is limited to relative to its biggest or bigger rivals. Similar to the S&P, the main purpose of the Fitch rating is to assess the security default probability. They also use the bond rating scale similar to the Standard & Poor rating. Here is the bond rating equivalent of the three agencies. The investor typically group bond ratings into major categories, which are the investment grade bonds or the higher grade bonds and non-investment grade bonds or the junk bonds. In investment grade bond, it contains a rating of AAA to BBB, wherein the Moody's rating scale is the AAA to Baa3. These bonds are seen as safe and more stable investment that are tied to a corporation or government entities that have a positive outlook. Here, there is also a strong capacity to meet financial commitment. In non-investment grade bond, it contains a rating of BB plus to D, or in Moody's rating scale is Baa1 to C. These bond ratings are seen as higher risk investment that are able to attract investor attention through their high yields. However, investor of junk bonds should note the implication and risks that are involved with investing in bonds that are issued by companies with liquidity issue. There is also a higher level of concern that deteriorating economic condition and company-specific developments could hinder the issuer's ability to meet its obligation. There is also the weakest bond, which contains the C and D. This is considered the most vulnerable to default. This category is reserved for bonds in special situations, such as on bond containing C are those in which the issuer is in bankruptcy but payments are continuing at present. And bonds that are in D are those which the issuer is in bankruptcy and the payment of an obligation is already jeopardized.